Joining us now to preview a big week of tech earnings is Angelo Zino, Equity Analyst, Senior Vice President at CFRA. Angelo, welcome back. So good to have you.
Great. Thanks for having me, Caroline.
So, of course, Nvidia is the highlight this week, but we'll also hear from names like Salesforce, Marvell, quite a few tech names. Before we get into those, though, AI has already made investors a lot of money, Angelo. Is there still easy money to be made here?
So, Caroline, I wouldn't say there's easy money to be made here, but I would say there's still money to be made. And I think it all depends kind of on how long this kind of cycle really goes. And I do think kind of the narrative has now shifted away from, hey, listen, all the focus on higher CapEx to more of the focus now turning to the AI monetization strategy and kind of making sure that we're seeing better kind of data points out there that point to AI monetization really ramping up. And we actually did see some really good indications here during the early parts of Q2 earnings season, whether it had been from the hyperscalers, in terms of posting some great cloud numbers and pointing to acceleration. Even some of the neo cloud players outside, when you think about it, and they get a lot of the kind of the residual demand out there away from the hyperscalers, but they've seen some really good pricing uplift on their end. They've seen some really good bookings momentum as well. So we're seeing some really good AI monetization stories start to play out. We need to obviously see that continue and get stronger as we go into 2027.
Dig into that a little bit more, though. What's the best evidence that all of this spending is actually paying off?
Yeah, I mean, I do think right now it is some of the cloud numbers. I mean, you get the cloud number. What happens is, clearly you get the greater capacity growth that's coming out there from the hyperscalers. You want to make sure that that capacity is being absorbed and taken out by their customers. Right now, a lot of it clearly coming from the Anthropics, OpenAIs of the world. But we need to see, more of these enterprise companies really kind of absorb a lot of this stuff. You're now seeing better stories out there, I think, from some of the software companies as well. It doesn't seem like it's all doom and gloom from the software companies. They're creating some great AI tools, and we are seeing momentum there as well. I think this, again, is going to be an important week from some of those SaaS players like a Salesforce, for instance. So, as long as we, again, continue to get those positive stories out there and indications of the enterprise purchases, I think, again, that helps. And of course, you want to see that token usage continue to grow, which, all indications are we are seeing.
Okay. So Nvidia reports Wednesday. You have a strong buy on Nvidia still. If I don't own it already, would I buy it before earnings?
I think you need to own some of it. So if you don't own it ahead of earnings, I think you should buy some of it. And I would say when you think about Nvidia here over the last couple of weeks, you've clearly seen a lot of the momentum names really. I don't want to necessarily say fall apart, but they've fallen clearly a good distance away from their 52-week highs. But when you look at Nvidia on a relative basis, has actually started to perform better than the broader semiconductor industry average. And the big reason for that is clearly they haven't been kind of thrown into this momentum trade in the first half of the year. As we go into this print, all eyes are going to be on Vera Rubin. Vera Rubin is that new kind of server that they are ramping up here that we're going to see revenue in the October quarter. So if we see stronger than expected demand for Vera Rubin, I think that could bode well here for the stock looking ahead.
Angelo, on that note, Nvidia is reportedly raising prices more than 15% on some of its next-gen chip servers. Do you look at that as pricing power or a reason for customers to look elsewhere?
No, I mean, I actually think, one, it's pricing power, and clearly component costs are going up across the AI ecosystem, and a lot of those higher component costs are naturally Nvidia is not going to absorb, and they're going to look to pass on to their customers, especially the hyperscalers. The other thing I would say is as you go into some of these next-gen servers, the whole focus for Nvidia is to continue to improve the economics, right? It's kind of trying to lower the total cost of ownership out there for their customers. So From that perspective, it continues to make an extreme amount of sense for these customers to continue to migrate towards these next servers. So I think it's the combination of the fact that, hey, listen, you've got to pass on these higher costs, and I think as long as they continue to successfully pass those higher costs on, they'll continue to do it. And second, it is the improving economics and what that means to the hyperscalers, and that, again, kind of allows them to have that pricing power.
We know, though, with a lot of these companies that the bar is pretty high, right? We've gotten used to these beat and raise quarters, so the stock might not react favorably, even if it's good news. What would actually disappoint you from Nvidia, and what would Nvidia have to do wrong, I guess, for you to change your strong buy rating?
Yeah, I mean, for us, I mean, the valuation is extremely enticing going into this print, which is why we continue to have the strong buy. As long as the market continues to act rationally from that perspective, I think it makes sense to continue to own the stock. As you go into this print, clearly what could go wrong and what, could make this, make us change our minds. Clearly, if the Vera Rubin ramp is not as positive as we anticipate, Street's looking at about 104 billion here for the October quarter. You should suspect at least a 1 to 2 billion beat from that perspective. But as you kind of, you want to see that trajectory continue to play itself out well. And if it's not, you want to know why, right? Is it something on the supply side? We do think that the supply chain is much better positioned with Vera Rubin than they were with Blackwell. So we don't think it's going to be a supply issue here early on. So if there is a demand problem, I would say, or if Jensen kind of provides guidance into 2027 that may not be as positive as investors out there would hope, that's something that would make you kind of revisit your thought process on the stock. But at this point in time, there shouldn't be any reason for that to be the case.
If Nvidia does stumble, does that help Marvell, which also reports this week, or a Broadcom, which reports next week, or do you think it hurts the whole AI trade?
It probably hurts the entire AI trade. I mean, the entire AI ecosystem is going to hinge on Nvidia. And I think when you look at the other names that are reporting here over the next couple of days and weeks, there are a lot of off-peak names, whether it be, to your point, Marvell, Broadcom, or even Micron next month, which all eyes are now on as far as the memory trade is concerned. It really all stems towards Nvidia because they continue to have the lion's share of the market here, and a lot of those companies, or essentially all those companies to some degree, do rely on Nvidia. Maybe Broadcom could be a little bit of an outlier, but I would say nonetheless, I mean, all those companies need to rely on Nvidia as well. So you want to make sure, as far as customer spending is concerned and their visibility, that looks good for the kind of the rest of the ecosystem to remain healthy.
Let's talk about Marvell really quickly because it's down about 4% today. But if you take a look, it's a more impressive chart year to date and for the past 1 year than Nvidia. It's up 167% year to date, more than 200% over the past 1 year. How are you looking at valuations on a Marvell? Would you buy the weakness that we're seeing today?
Yeah, I mean, listen, we like the Marvell fundamental story a lot, and we do think it has pulled back enough from its peak. Where a lot of that, maybe a lot of that fluff out there has kind of been taken out of the stock. I think this is one of those names you definitely have to keep an eye on, and a name that we do like a lot. Going into the print here, I mean, all eyes are going to be on a recent Google announcement that was made last week. We think it has the potential to drive significant upside to expectations. So we would own the stock. And I think what dictates the move on Marvell has almost nothing to do with the actual numbers itself, and everything to do with how they articulate what that upside potential and what reality for that contract is going to look like here over the next couple of years, because it really does have the potential to drive significant upside to some of our out-year numbers.
Okay, let's move on to Salesforce. It's actually higher today, and it's well off the lows, but still down about 20% year to date. What does Salesforce need to prove this week?
Yeah, I mean, Salesforce is a tough one. I will say, what they've got going for them, obviously, right now is the fact that the software trade appears like it's getting some momentum here over the last couple of weeks. And a lot of that has to do with the fact that these multiples have gotten so depressed, and the fact that it doesn't look like, at least at this point in time, we've seen any sort of massive destruction in terms of the fundamentals on the software side of things. So for Salesforce, I would say what you want to see is you want to see the core business, their subscription-oriented business continue to remain healthy. We think that will be the case. There could be some weakness, or they could disappoint slightly on that side of things. And then more importantly is what they have to say in terms of the momentum for Agentforce, what they're seeing in terms of that inflection here in the second half of this year, because that is a big part of this story. So if they see a really good inflection, if they start seeing a lot of kind of pilot use cases, move to full production, and we see some really good growth numbers out of their AI-oriented business, that might be enough to kind of convince some investors to continue to buy up the shares and get a little bit more optimistic going into 2027 on Salesforce.
I mentioned it's well off the lows, but still down on the year. Do you look at it as an AI bargain then, or is this a value trap?
We do look at it as a value trade at this point in time. I wouldn't necessarily call it a value trap because we do think the core business remains intact. We do think there are signs and ways that they will continue to improve the margin trajectory of their overall business. And then at this point in time, it almost kind of, hey, listen, if that AI business really starts to swing in favor and does what it needs to do, we do think you can kind of maybe see a re-rating to the upsides, at least slightly on the multiples, and that could drive easily another 20-25% upside here in the shares. But I would say here, when you kind of think about just the broader software trade, what you do have to be mindful about is, hey, listen, you've got the Anthropic AI IPO coming out probably in a couple of weeks. You've got OpenAI probably in the first half of next year. When they actually do IPO, they're going to be able to generate a ton of proceeds. They're going to be able to reinvest in that business, get a lot more capacity built there, and it's going to allow them to really announce a number of new offerings on that side of things. So I wouldn't necessarily say you're out of the woods at this point in time as far as the uncertainty in the software side is concerned.
What's a software stock that you think will hold up and do well regardless of what happens with AI and software?
I mean, I don't know if I'm allowed to give this answer, but I would say Microsoft. I mean, that might be kind of a cop out, but we continue to be extremely bullish on the Microsoft play, and obviously they've got the cloud story and what have you. But it is the fact that we are still fairly bullish on the Copilot momentum and what they're doing in terms of the application software side of things. So that's a name we do still like. And I would say maybe if you're looking more pure play application software, ServiceNow is another name we like as well.
Okay, so you kind of said how to think about the software trade overall, still not out of the woods. How should investors, especially retail investors, be thinking about the overall tech trade at this point in the cycle? What do they need to consider? How should they be thinking in terms of market leadership?
Yeah, I mean, I think that's a great question. I'd say right now, what I would say is you want to be a lot more balanced in nature across the tech, the overall tech space. And we continue to have an overweight weighting on the IT sector. We have since 2022. And what I would say is, clearly the last 3.5 years, it has all been on the kind of the semi side of things, the AI infrastructure build. The comps obviously get a lot more difficult from here, and nobody knows kind of how long in the tooth this cycle really goes, right? But all kind of indications are what you're going to see on this moving forward is likely multiples continue to impress. We know the fundamentals on the AI infrastructure build probably hold up and remain very strong through 2027, just based on our forecast for the hyperscaler CapEx spend. What it looks like in 28 and beyond is what the market is trying to figure out. So as long as, what we tell investors, as long as the market stays rational, and that means discount those risks, compress the multiples a little bit, but see that good earnings growth trajectory, I think that's why you remain invested overall, but you stay balanced across software, semis, as well as big tech, because big tech should be able to provide some nice downside support if we see some volatility there.
Does balance mean 33.3% in tech, 33.3% in big tech and the rest in chips, or how does that balance look?
Yeah, I mean, what I would probably say is, I mean, I would probably be a little bit more bullish right now on more of the, still on the semi as well as the, let's call it the hyperscaler side of things. So maybe 40-40 and then 20 on software. And if we continue to see some better monetization stories on the software side of things, and maybe the cycle continues to get longer in the tooth, and maybe some uncertainty on the semi side, then you increase your exposure on software. But it would maybe be a 40-40-20 mix.
If I already own plenty of big tech through the S&P 500, so I kind of have that covered, and I'm thinking about where my next dollar goes, where should that go first?
Yeah, I mean, I think that's a great question. I think we continue to be, I'd say, more focused on growth at a reasonable price. So I would say continue to invest in areas of growth within tech, maybe kind of a growth-oriented tech ETF over value. But nonetheless, I mean, you still want that value exposure, but still focus on growth within the IT sector is what I would say.
Okay, so before we even get to rapid fire, quick answer here. Best growth stock that comes at a reasonable price is?
Microsoft, in our view. I think that's kind of the way to look at this. I mean, you kind of look at and this is if you're a long-term investor, right? We look 3, 5, 7 years out, and there is a lot of uncertainty in this market still across the AI infrastructure trade. But Microsoft is a name that has been very diligent in terms of how they spend their money, being very rational with it. And that's a company that we just trust a little bit more when it comes to the management team relative to some of the others out there.
Okay, all right. I think this is a great time to pivot to our rapid fire, to officially pivot to our rapid fire game of this or that. You've played before. Quick questions, quick answers, no hedging if you can help it. Are you ready, Angelo?
Let's go.
AI boom, early, middle, or late innings?
I'd say middle innings, but also be mindful of the fact that we are likely going to get some choppiness along the way. So there will be fear out there that maybe we are approaching an end, but our view is probably middle innings.
Buy any dip? Yes or no?
Yes.
AI spending, accelerating or peaking?
Peaking, with semiconductor sales likely having peaked here mid-year, but nonetheless, we do expect growth numbers on a year-over-year basis to remain attractive over the next 2 to 3 years.
So next wave of AI winners, chips or software?
We do think chips are still a good place to be, but the way you would play chips might be different looking ahead. So it may not be memory like it has been over the last 12 months. It may be the shift towards more networking-oriented plays, potentially like a Marvell, as we kind of look at that shift away from copper to laser, for instance.
Chips or data centers?
Chips.
Software, AI winner or AI victim?
It depends, but we continue to be positive on the fact that you're going to see a number of AI winners. It's all about finding those winners.
One AI winner that's a software name that's not Microsoft.
I would say ServiceNow.
One AI software name that will likely be a victim.
Adobe.
Better value, Salesforce or Nvidia?
Still Nvidia.
Hyperscalers or semis?
Semis.
Nvidia ahead of earnings, buy or wait?
It depends. We would buy, again, if you're not invested at this moment in time, we would buy, and we do expect overall Nvidia to perform well. It just may not see the reaction some investors want to see.
Broadcom or Marvell?
Marvell.
AI stocks, stick with the leaders or bet on the laggards?
Probably still stick with the leaders because most of the leaders continue to see, at least on the semi side, continue to have some of the best content stories that are out there. And historically, the way to actually benefit or win across the semi ecosystem is to find the best content winners out there.
Okay, it's time for fill in the blank. Finish this sentence. The AI leader I have the most conviction in is?
Microsoft.
The AI laggard most likely to become a leader is?
And I don't know if this is a good answer, but I would say Meta. They're not necessarily a laggard, but the stock has absolutely lagged here over the last 12 months. We do think that is an opportunity.
The best AI stock to buy today is?
AMD. That is a company where we think the earnings power remains significantly underappreciated, and we think has probably the longest tail among kind of the names within our AI semi ecosystem.
The AI stock I'd be most nervous owning is?
Probably Adobe, if you consider it. Or I would say kind of some of those content names out there that could potentially be easily replaced by AI.
What's a content name? Give us an example.
Yeah, I mean, I think Adobe is a really good example in terms of just if you're a company that just relies on if you don't own the actual data out there is maybe the best way to put it. The companies that do own the data, specifically on the software side, will be the biggest winners there.
The first sign the AI boom is in trouble is?
When neo clouds start cutting capex or can't I would say get the actual funding that they need to meet some demand expectations out there.
The market is underestimating blank.
We think Meta might be the best way to put it. We think they are not properly pricing in or factoring in the potential AI monetization story there across a number of different levers that they have.
Nvidia's biggest threat is?
Probably hyperscalers with their own custom silicon chips, I would say. A close second would be AMD. We do think AMD is doing a lot in terms of some of their software initiatives. If that kind of ramps up and gets more formidable quicker than people anticipate, that could potentially be problematic for Nvidia.
Of the biggest year-to-date winners, SanDisk, Micron, Dell, and Seagate, the one I'd still buy here is?
Micron. We expect them by the end of this year to announce a significant capex plan, and we do think there's a really good floor here for the stock, just given our view of the fact that you look at the free cash flow potential as well as the balance sheet. We think it's just a name that you continue to stick with.
Of the biggest losers, Oracle, IBM, Adobe, Zscaler, Salesforce, I'd bet on?
Salesforce.
When all is said and done, the company that wins the AI arms race is?
The company that can continue to grow, but also be prudent in terms of their spending plans.
If I had to guess which company that is, it is?
I would say Microsoft. Obviously, I would also say Amazon as well. There are two names that we do like a lot. I would also say a name that we haven't thrown in is Apple. As we eventually kind of shift towards edge devices, we do expect them to be a big winner.
So the one AI bet I'd make for the next 5 years is?
I would say AMD, followed by Qualcomm. Actually, it's a name that really hasn't had the move yet. But it's a name, again, as we shift towards edge devices and you look at the multiple there, as well as the fact that they will be a big beneficiary of 6G towards the end of the decade, there are enough levers, whether it be tied to AI or even not tied to AI, that should make them a huge winner, especially given the valuation there.
All right, we managed to squeeze in so many names there. Angelo Zino, thank you so much for playing along and for getting us ready for tech earnings this week. That's Angelo Zino, Equity Analyst, Senior Vice President, CFRA. Always a pleasure. Thanks so much, Angelo.
Great, thanks for having me.
If you enjoyed this Street Talk, check out our full interview with Ahmed Riezgo. He has a 7,800 price target on the S&P 500 and explains where he'd take profits and what he's rotating into.